The content discussed in this podcast is for informational and educational purposes only and should not be construed as financial or mortgage advice. Always consult with a licensed professional before making any decisions regarding mortgages or financial matters.
Welcome to the Canadian Mortgage Show. Here are mortgage professionals Alex Pang and Alex Shanks to cut through the BS and educate Canadians on all things mortgages and real estate.
Just like what Alex said, you stress test your portfolio, make sure the numbers work and allow for like vacancies. And like before, people would invest in GTA and Lower Mainland. The numbers didn't really cash flow, but they're banking on appreciation. And it worked. It worked for a bit, but that is no longer the case. We can't bank on home appreciation for the next little while. And especially in the Lower Mainland GTA, right now, it doesn't really make sense to invest it because the numbers don't work. But if you're investing in other areas, make sure the numbers do work and that it at least cash flows. Welcome to episode 67 of the Canadian Mortgage Show. Alex Pang here alongside my co-host Alex Shanks. Alex, how are you doing? Things are getting cold lately, hasn't it?
Yes, I mean, on the island, we've just been wet. It hasn't actually been all that cold. It's been really wet. Kind of sucks. Our mountain, it was meant to open here, I think this Friday. It's not going to be opening, and yeah, we're still waiting for more snow here. And so I wouldn't mind it actually. I'd rather it be cold than just wet.
Well, I think it goes hand in hand, especially on we call it the wet coast. It's cold and wet, especially when temperature is even at 10 degrees or lower, it gets cold when it's wet. So, people out in the out east or in the prairies, when it's cold, it's usually snowy and it's brighter. Out in the wet coast, it's cold, dark, and gloomy. So, I mean, I'm born and raised here. I'm used to it. And I actually prefer the rain over the snow because you could drive in the rain, whereas we don't get snow that often. If it does snow, it is mayhem. It is Armageddon on the road. A 30-minute drive could be 2 hours when roads are blocked off, highways are closed. People are slipping and sliding because not everyone.
That's just because most people in BC don't know how to deal with it.
Yeah, and they don't have snow tires, and it's the whole justification of it doesn't snow here long enough to justify the snow. The same thing before whole global warming came about is most people up until probably 10 years ago didn't have ACs. Because it wasn't hot enough for a long enough period of time to justify the cost. Same thing. But the extreme weather and climate change and all that stuff has kind of warranted that. Yeah. So I'm going to the Canucks game tonight. Clients taking
nice.
me.
Who are they playing?
They're playing Buffalo. The game he picked, he gave me some options. And at the time, Canucks were kind of competitive. Or we're still kind of decent. And then I'm like, okay, let's pick a game where we have a decent chance of winning. Well, yeah, I don't know. Our team just kind of went down the toilet. We're last in the league and talking about trading Quinn Hughes and just blowing it up. And you know what? I'm on Team Tank and I'm like, it's which is kind of anti-fan-ish. I'm not going to cheer for a win, but I'll cheer for 3 goals and then we lose 5-3 or 4-3 or something like that. I don't know. Have you ever experienced that as a Leafs fan? Cheering for a tank and
that's all the time. That's pretty much. I just feel like it's either we're cheering for winning or we're cheering for losing. I mean, it's I don't know. I think Leafs don't look good, and it's kind of the same thing as Vancouver. They have a core of people that it should be good. They should be a good team, but they just suck.
I guess losing Mitch Marner really has done a number to Austin Matthews and the whole mix of the team.
I mean, I feel like we don't know how injured Austin Matthews was, his wrist, how badly did he injured it last year? And I mean, they've tried to change the way he plays hockey and everything. And so, I mean, I don't know. I feel like this is pretty normal Leaf stuff. But again, if nothing happens this year, there'll be more players being booted next year.
Yeah. It's just the way fandoms. When you follow teams, they go through up cycles and down cycles. There might be periods of, sustained success, but our teams right now are going through an unexpected dip, more so on our side than you. So we have some big news as we start the show. Do you want to lead us off?
Yeah, I mean, this is it. I mean, I'm going to make my social media video today on this. I didn't have any time yesterday with the Bank of Canada on December 10th. They're coming out and holding their policy rate at 2.25. It was very widely expected. There was pretty much no ifs, ands, or buts. I mean, some people are like, it's going to be an increase. No, it was never going to be an increase. Now this just comes off after the data of the unemployment actually dropping. Now, Alex and I were talking about that. I was looking back. We talk about bonds, as we know that fixed rate mortgages are based on bonds, variable rate mortgages are based on the Bank of Canada and prime rate. And you can go back to last December. This exact same thing happened. The GDP and all the job reports come out, and you got Black Friday, November, you got Christmas shopping, unemployment goes up. Like it's going to happen because there's more people, and these were all part-time jobs. These were not full-time jobs. And so it's easy to skew the data. We even go back to the GDP. It's based on because the government is spending a bunch of money. So like all these numbers are inflated. And so I take this all with a grain of salt. I don't love what the bonds have done. It's definitely something that I'm watching quite heavily, which to me, what we have to watch is the bonds and inflation. If inflation keeps going up, we got a problem that way. And this is where we need to watch, especially when you talk about people that have variable rate mortgages right now.
Yeah, I mean, we talked about this last week. Because of this, we kind of feel it's an overreaction. Fixed mortgage rates have climbed because bond yields have kind of shot up. I mean, most of the 5-year fixed rates have moved back in above 4% because the bond yields have pushed higher. And then we've been talking about it too last week and right now. Is the data as strong as it seems? I don't think so. And both of us are calling BS on it. Like, just like Alex said, the job growth mostly due to part-time jobs and young people, especially seasonality. We're heading into the holidays. Companies, businesses are ramping up their staff for the busy season.
Yeah, and it was youth, 15 to 24-year-olds. And so again, like these aren't like long lasting jobs. There are people even like seasonal for mountains and everything. They hire a bunch of people. And so it's there. It's again, like we have to watch this. Like if we see inflation ticking up more, and this is where the US is a little bit worried, they did drop their Fed, they dropped a 0.25%. But Canada, we've already been ahead of that. We've dropped significantly more than what the US has here. And so that's where we have to watch what they're doing. And if they're going to keep dropping, that is where it's going to change. They kind of talked about that they're going to be holding here right now. And I feel like we're going to be holding. We need to see what's going to happen. And we can go back to the start of last year. Like we should do a recap. We should take some of our notes, Alex, from 2024 last year in December and kind of go over some of the stuff that we talked about. Obviously, we didn't know what Trump was going to be doing with tariffs and everything. That has just completely changed what 2025 looked like. Elections, like so much stuff has actually happened in 2025. And that's where we're still just like coming out of turbulent times, and there may still be more turbulent times ahead.
Yeah, absolutely. And, tagging on to the unemployment dropping from 6.9 to 6.5, half of the drop was actually due to 30,000 Canadians just stopping looking for work. They just throw their hands up. They can't find a job. Maybe they've been looking for months and months, and they're like, you know what? I'm just going to not look and just, collect EI for the time being. So on those numbers, they're actually not counted as unemployed. So both of us feel that once the dust settles, once the holidays are over, and we're coming into January, February, then we'll be back into the the crappy numbers that we've been seeing leading up to this November, December period. So, I mean,
yeah, I mean, we talked about it last time. Like, there's job layoffs coming for Algoma Steel, 1,000 people in Ontario. That's not going to be until March. Like, there's more layoffs coming here and everything, which is not great. And that's where I feel like the bond traders have overreacted to this, but they're looking at the underlying data of what is the GDP doing. It's going up. Job reports are going up, and so they do have to react in that way.
Yeah. Unfortunately, us in the industry, we're looking at a little bit zooming out more. Like we've seen this before. It's only seasonality, and for this period, and it's obviously overreaction, especially when it comes to mortgage interest rates. We've been kind of
But that's where I think that's why like the nice thing I like to say is we have the data of 2022 there, Alex, when like shit went crazy. Inflation was transitory. Inflation wasn't going to keep going. And so that's why we need to watch what the bonds are doing. And they're down today. They started at near 3, and we're now going down towards 2.938. About a week ago, we were sitting at like 2.7. So they're still elevated. Some lenders have started to increase their fixed rates because those are based on the bond yields there. And that's where we're in a bit of a weird time. This is actually where variable rates are now, in some cases, significantly lower than a fixed rate. But I do believe it's data that we need to watch. It's not something that we want to stand by and be like, no, don't lock in yet. But if I kept seeing bond yields increasing, we might want to know like, oh crap, is this the time to lock in? Or would it happen like 2022 where we were just chasing this dragon? We never could catch up to it.
Yeah. Yeah. So, I mean, this kind of shifts the conversation now. I mean, we kind of mentioned it last week. If you're looking to buy and are considering fixed, you probably should have gotten a rate hold by now. Your mortgage broker or banker, or you heard our episode last week, you probably should have gotten a rate hold by now. Like, I haven't seen a lot of lenders in our broker space who have announced rate increases yet, but we are seeing it.
Yeah.
Not quite yet, but if you haven't done it, do it now. Now, the next question, we've been talking about this for a good part of a year, is if you're on variable, is it time to lock in now, or should we just wait for this momentary dust to settle for December to roll into January and wait?
And that's where I feel like, Alex, in my case, like I've had some clients where we're having them reach out to see what the lenders are going to offer for fixed and everything. Right now, to me, they're just a bit too high. And that's where I like to see, like, I know some clients that have got renewal offers. I have one mortgage that has a renewal offer and my renewal is 3.69. Now, when you get a new purchase, there's a premium on that fixed rate because the lender has to hold it. They're basing on the bonds today. So they have volatility in there. And so that's where if I kept seeing the bonds going up more here and we had other data, like let's say the Fed didn't decrease rates, well, again, our data would be saying, hey, maybe it is time to lock in. I don't think we're at that yet. I think maybe we see what December and January holds. But again, it's just something that has to be watched. It's not something that we want to forget about.
Yeah, I mean, most of us, we believe that in reality, the economy is going to, once this momentary blip subsides in January, the economy will continue how it was, will kind of deteriorate. More job losses we'll see, all that stuff. And, I think that, they are going to hold. They say that Tip Macklin said that our economy is proving resilient overall. We're really calling BS on it. And he said that we're at about the right level at this moment, but I feel that they will start resuming cutting again, maybe in the springtime. Maybe that window of locking in will be at that springtime when they start cutting, 25 to 50 basis points next year. Now, the market odds at this moment is calling for a rate hike in October. I can't see it right now. Like, if anything, like let's see how the next few months go, because really, like, forecasting that far away is kind of foolhardy at this point.
Yeah. And that's what I mean. Again, obviously, like right now, variable rates are lower. And that's where it's like, hey, you can ride a little bit of that lower. And again, if economy does change, if tariffs are really going to be staying and inflation is coming up higher, like it is going to be a time that, hey, we are going to have to, because our economy is going to be different. I don't know if you see, Alex, I saw it lots on the social, is fear-based. It's just straight fear of even mortgage brokers. Like, and again, people are using it to scare people into like, hey, yeah, you got a mortgage coming up for renewal and you should break it today. And it's like, I don't think we need to use fear-based for people. Like give them the real information. Look at the options. Hey, if you're at a higher rate, yes, it makes sense to break your mortgage if the penalty's there. But like, I got a 1.5%. I'm not getting rid of that at the moment. Even if rates went up by 0.2, I'd be better at keeping my lower rate than breaking today.
Yeah. I mean, this all comes to, more stuff that comes out from the whole jobs data. The drop in unemployment, like we talked about, largely part-time and for youth. we've added 63 part-time jobs, but lost 9,400 full-time jobs. So this kind of goes into the whole seasonality that we talked about. 50,000 of the new part-time jobs went to youth, like we said. And I mean, we're going to see a unemployment go back up again after Christmas once those seasonalities.
Yeah, but we won't get that data until about February. That's the weird thing, is like we're probably going to get another increase here for December. And when we get the report out in January, and that's where, if you want people, go look at the bond yields, and you can compare it 2024 to 2025, and it looks near identical. With the spike, it then was a decrease, and then tariffs started coming in, and we had a massive spike in the bond yields, and then we started to level out. And so there's some signals that can be watched that way. And so I wouldn't say I see February is when we'll see the jobs being taken away again, but until then, it's probably going to show even better unemployment.
Mm-hmm. Well, remember last week or a couple of weeks ago, Remax gave a forecast for 2026, and they were pretty optimistic, and we're all like, okay, well, you're trying to appeal to your masses, to your agents and stuff. Well, Royal LePage had a forecast, and I think I put more credibility in this one. They're saying the Canadian housing market is primed for a reset, with more buyers expected to return in 2026. Now, they're forecasting national home prices to edge up 1%. Single family homes seeing slightly stronger gains, but in reality, seeing Toronto area homes drop by 4.5% by the end of 2026.
Yep.
I think this is more like reality based on this one. They see the writing.
That's why I like it. I was like, hey, you know what? Roy LePage is actually being honest and not trying to pump the market like a lot of people think realtors do. It's like, hey, this is being real honest. Like yes, prices will probably start to come back at some point in some places. Again, Alex and I have talked about it. My area, like we're going where we have growth. Other areas aren't. And so that's where in the Toronto area, like there's not growth. Like that's not going to be happening right now.
Yeah. Yeah. So, I mean, I give more like credibility to Royal LePage. I would listen to that one more than the Remax one for sure.
No, exactly. And but again, the data is always going to be changing. This is another interesting one. And I really like the take that I saw on social media for it. It's obviously our asking rents are still dropping in Canada, which fell to 2,074 in November, down from 3.1% from a year ago. What this means is, again, there's no demand for the rental and housing. Like, it's showing that there is a surplus out there. Hardest thing is the price of homes haven't really come down enough to really make a difference. And so until rents stabilize, I would put money on it that we're not going to see rent like home prices increase until rents are actually been stabilized. Because right now the market's just saying, hey, you can either rent your place and I'll take a lower amount. I talked to one landlord there yesterday, and he was in a group, and everyone's really saying, stop lowering rents. We don't want that to happen. Give concessions. Be like, oh, we'll give you X amount utilities for free and everything. Because obviously, like, people don't want to keep putting this floor. It's like a race to the bottom right now.
Yeah. I mean, a lot of this too is combined with immigration being shut off. No temporary foreign workers coming into stoke demand. And but yeah, I mean, it's bad news for sellers and landlords, but good news for renters and buyers out there. So it seems it goes back to this narrative of we always seeing these huge pendulum swings of one thing to another and never any balance. So we're kind of feeling like it's coming back down. It's almost like these last 3 years are erasing any of the COVID crazy gains that we've seen before, like 2020 and such. So this next set of data, CMHC has started tracking a new data set. Development charges amount to a whopping $130,000 per apartment unit in Toronto. So if you see on this graph here, see this big climb here on the left side, that's Toronto. And the next highest are all the other GTA municipalities, Markham, Brampton, Mississauga, Newmarket, and then Aurora, Pickering, Ajax. Yeah, so basically most of the GTA Golden Horseshoe. Now you see a sprinkling of lower mainland municipalities with Coquitlam, Burnaby,
Burnaby, yeah.
Langley, Maple Ridge, Pitt Meadows, Port Moody. So yeah, it's all the expensive metropolitan areas of the GTA and the lower mainland. Now Vancouver is not included in this, but definitely we are not far behind, or we are probably close to this Toronto area mark on the development charges, which, thankfully last week we kind of reported that Vancouver has decided to lower development charges by 20%, because 20% of 80% of a lower amount is better than 100% of zero. So I'm glad they're seeing the writing on the wall. I mean, will it make a difference? If the numbers don't make sense anyway, they ain't building nothing. That's
Yeah, I don't know. I still feel like it's going to be hard. It's going to be nice for maybe some people on some smaller side developments, but I just don't know if it's going to boost it enough right now. And that's like where Brendan Augustin came in. It's like, we do need to let some foreign investment come in here. That's really what's needed here. And that's where it's, again, trying to figure out a way of, well, can they only buy these under CMHC as rentals and everything? Like, we have to bring capital from somewhere. It's not coming from internally in Canada here right now, unless there was a way to give business owners a better boost.
Yeah, I mean, tagging on that, Ottawa is actually weighing tax reforms to attract foreign capital for real estate developments, because right now it's virtually nothing. I know politically right now it doesn't look good because they've been largely blamed, or a good portion of it contributing to how we got here. Now, currently, there's a 25% withholding tax for any foreigners before they can take any of their gains out of Canada. So they're weighing it. I don't know how I feel about it. Like, we were glad when there's this Ford buyer ban for the next until 2027, but maybe they were the only reason of building in the first place. So I feel like there needs to be some sort of balance.
Yeah, and that's, again, we can't. It's not the foreign people that came and bought and ruined this all. It was the Canadian misoversight by the government of saying, like, they could have easily saw, like, holy crap, like, this is a lot of happening in a year. Like, I understand, like, oh crap, you know what, we messed up over 6 months, didn't realize it was going to boom so much, but like, this went on for almost 10 years, and there was no, like, people just kind of got happy on all the money that was coming in. It's like, there was very clear signs that this is not going to end well. And I mean, they tried to do so many things with the foreign, like, vacancy tax, property taxes. They tried to do things, but it should have been like, hey, you know what? You can maybe only own one unit in Vancouver. You can't own 20 of them. Like, there was other things that they probably could have tried doing.
100%.
Equifax, following a decline over the 4 consecutive quarters, consumer insolvencies rose in Q3, with Ontario and British Columbia seeing large annual increases. Now, these large annual increases, I mean, like, we have to remember, people, these are very small amounts. Like, in the reality of things, the hardest thing is people's, like, their, like, consumer debt is at all-time highs. That's not only just because of what's happening. We showed it, I think, 2 or 3 episodes. Consumer debt since like 2005 has just been skyrocketing, and it's people using credit cards. And I mean, every time I go to Vancouver, I always see it out. So I'm like, how are these people, like, there's so many restaurants out there, all this stuff, people in fancy cars. And I'm like, how, like, I know that I'm well off. I'm not going to do that. I'm not going to go spend and waste that money. But those people are doing it on debt, and it makes them feel good. I don't really know what it comes from. And then on here is, for bankruptcies, things happen slowly then suddenly. Hardest thing is here, some of this data is going to be lagging, and bankruptcies don't just happen overnight. And that's where I personally, I don't see people going bankrupt as much here right now. There's been more in the past. The scary time is going to be here in 2026, when people have their $1 million mortgages up for renewal from 1.5%. That's really where some of the stuff is going to start to come into play.
Yeah. If you look at the second graph here, it's showing that most of the delinquencies are Ontario and BC. Surprise, surprise, because our home values are the highest. And because of that, our mortgage amounts are probably the highest. You're not going to see $1 million mortgages in Alberta, Saskatchewan, Manitoba, or the Atlantic. You'll see them in the Lower Mainland and the GTA. Those are like nothing new for us. But yeah, you'll see on this graph here, more of the delinquencies, 90-day delinquency rate has risen. It's doubled, but I mean, it's doubled from 0.1% to 0.2. It's still low, but yeah, we're seeing that people in the GTA and Lower Mainland are being stretched financially for sure.
And I mean, I've seen it, and I mean, I've talked to, and I hope the people I talk to is a lot of people. They have the pre-sales coming up. Like anytime I talk to someone from Ontario, it's they're wanting to do like an advanced mortgage strategy to save money on taxes and everything. But when I talk to them, it's like they have a pre-sale coming up in 2 years. They don't have the funds for it. Another one coming up in 3 years, and like just trying to sit with people and say, hey, like you need to cut your losses today. You need to sell your other assets. Like you don't qualify for this stuff. And I mean, no one wants to like say, crap, throw their hands up and giving up, but it's only going to get worse. And that's where for sure it's scary out there. And I've seen the people, I'm like, you have equity in your homes, just sell a few of them and restart your life, or you're going to dig yourself into such a bad hole that you're not coming out from it.
Yeah. I mean, I'm dealing with a client too, who's also in a similar situation, who, like many people, bought a pre-sale, hoping to flip it, make money, and repeat and rinse and repeat. It worked in the last, I would say it worked for the last 10, 12 years up until, the fallout of COVID, but the bottom has fallen out on that. Like you can't do that anymore. And, people who had no business closing or had no intention to close, hoping to flip it for, 100 grand, 150 grand more, couldn't do it. Ended up couldn't assign it. And they ended up having to close, oftentimes with the private, and I'll talk about it later, some creative strategies how to do, but they're not long-term solutions. Sometimes you might have to just eat your loss and sell it at a loss, take the hit, and rebuild. Doesn't mean real estate investment, you should never invest in real estate again. No, it's just this time, this wasn't like doing it that way. Flipping was not investing. It was just speculating. It was essentially gambling.
Yeah.
It was essentially betting on black and it landing on red or zero. Right. So
yeah, when I buy real estate, especially if it's going to be for my principal residence, and me and my wife, we're actually trying to buy a different place here. We run scenarios of like, we're not buying this is for us to live in. Like, hey, awesome if it appreciates a little bit, but like we're not banking on that. And I like to run scenarios of like, what if we buy this and the market drops in the next 5 years by 20%, 30%, 50%? We're leveraging ourselves because we have other properties. So there's other debt coming with us. And so like, I look at stuff in a very, very worst case scenario all the time. And only if it works in the worst case scenario for me, do I move forward with it. And that's where we even ran a scenario like, what if the market dropped 50%? Would we still be in an okay position? And we would. And so I'm like, hey, you know what? That's never going to happen. We've even seen that. Like in some areas, the biggest drop we've seen is like 30%. And that's when people bought places for $1.5 million that really should have only been sold for $800,000. And so you have to run your own numbers. And we have the stress test when you get a mortgage. I like to add more to that myself. That's just how I like to live. And it's allowed me to do what some people think are riskier things, but I know that, hey, I have backups to those backups.
Yeah, 100%. I mean, just like what Alex said, you stress test your portfolio, make sure the numbers work and allow for like vacancies. And if like before, people would invest in GTA and Lower Mainland, the numbers didn't really cash flow, but they're banking on appreciation. And it worked. It worked for a bit, but that is no longer the case. We can't bank on home appreciation for the next little while. And, especially in the Lower Mainland GTA, I keep saying it, right now, it doesn't really make sense to invest it because the numbers don't work. But if you're investing in other areas, make sure the numbers do work and that it at least cash flows. One of the guys I listened to on the Looney Hour, Richard Diaz, put up a cool graphic here on Canada's net exports by type. So if you see this on the video side, we are exporting a lot of natural resources out, and it's good. Tags onto what we talked about last week with Alberta signing a deal with Canada, trying to get a pipeline, still hoping memorandum of understanding at least. We're selling our natural resource.
I think that just got voted yesterday, Alex, that all, like, even Mark Carney, who wrote the bill for this, they voted it down. It got brought up in the House of Commons, and it didn't happen.
Oh, so this MOU is not happening at all, or
I don't know the MOU, but the pipeline. Sorry, pipeline. I'm talking about the pipeline. The pipeline's not happening. Like the Liberals are the ones that brought it up and said it, and they then voted again.
What are we doing, people? I don't know. But anyways, back to this graphic here. We are selling our natural resources, but we are importing the rest. But he's saying that we're selling our natural resources to pay for our imported goods, like all our consumer goods, like electronics, vehicles, machinery, plastics, services, and all that stuff. So, I mean, we really do need to, as a country, not exploit, but like use our natural resources. Now, if we can create our own consumer goods, great. But, a lot of it's from China, other cheaper parts of the world for labor force and such. So, but this is interesting. So StatsCan on segue on that one. StatsCan posted its first goods trade surplus since January, as the stronger exports and weaker imports help pull the balance back into positive territory. So now, if you see in this graph here, the preceding months were huge deficits in trade, the trade balance here. It was expected to be a $4.5 billion deficit, but we posted a paltry 153 million surplus. So that's kind of good news.
I like to know why. Like that's a pretty, like, again, that, like, the numbers there, like, to go from where we were at to that, like, I would like to know where that's come from. Because it to me, it doesn't make sense. Obviously we're not trading as much with the US and everything. We've gotten some new partners, but I feel like there's some fancy accounting going on here.
Yeah. StatsCan, the old random number generator.
Yep. And I mean, we got this. It was nice to see this in the news, is that Microsoft is to invest more than $7.5 billion in Canada to boost AI infrastructure. I mean, it's nice to see that a bigger company is like, hey, you know what? We should be doing stuff in here and not only in the US. Now, I'd be really interested to see what Trump is going to say on this, because he's probably going to be pissed by it.
I hope this isn't like the Nokia thing. We are giving these tax incentives to Microsoft and be like, well, yeah, maybe, but at least, like, you're going to invest here, but then all of a sudden lay off or something like that. We're going to give you all this stuff and then you take jobs away. But it's good that this is the first positive news I've seen about investment in Canada. Now, we sometimes report on compliance stuff or regulatory stuff. Here's one out of Ontario. RICO, which is the Real Estate Council of Ontario, issues a public advisory regarding Home Life Today Realty in Ontario. So they confirmed that there was a shortfall of $580,000 from their trust account that the brokerage wasn't able to correct. So what is this telling me is that, yes, real estate industry is not doing well. Agents aren't making as much. Brokerages aren't doing as well. So what's happening? Are they just stealing from the trust money and hoping to borrow it, but give it back another time, and it just snowballs from there? They're just
that's a positive steal out. I mean, that's everyone's hoping, but it's like how it really blows my mind. I mean, like how do you think that's not going to get caught up to you?
Yeah, I mean, it's not your money. So I mean, people like, with the greatest intentions, it goes awry, and like, we're going to see more and more of these kind of things.
I mean, the more this news comes out, like, it's just going to, for one, it's going to scare clients that want to put deposits in. Be like, oh, you want me to put $100,000 deposit? I mean, and I can see what's going to happen, or people are going to scale back their deposits for stuff, because why would, if the trust company is just going to start siphoning off, and if they had to close here today and there was no funds in it, like, they're screwed. The clients are screwed. There is no questions on that. They would have to come up with that extra money because the trust doesn't have it now.
Well, I mean, we're going to see more and more audits now from for compliance from these regulatory bodies. And I mean, one broker mentioned, should, instead of being the real estate broker's trust account, should it now be in the lawyer's trust account? But we've also heard too that there have been nefarious lawyers who have stolen trust account money. So, I mean, not to say that, we're saying 99% of people are good, but of course the 1% just paints a bad picture for the industry and for our professionals.
So 16 metro mayors calling on the province of BC to pause and reconsider multiplex zoning. Again, guys, this is stuff that has already been talked about, and it just they're not wanting to get on board with this, which is, to me, it's very interesting. And again, you get some what's the term, Alex? I can't think of it right now. Not in my bad. NIMBYism. Yeah, NIMBYism, and that's where a lot of these are. These are people that are getting, the mayors are getting it from people I don't want this in my backyard and everything. And again, it's guys, we have to build other types of homes. We can't just keep building skyscrapers because those can't go everywhere, and they're not going to be able to house families. We have to build these, and I do believe that they need to be considered properly. We can start to see what's going on with Calgary. I think there's going to be a major drop off in rent prices there because they're just oversaturated now. And so that's where I think they need to be better ideas of okay, hey, in this area, we should only have 10 of these, not 100 of these. They do need to think of it that way.
Yeah, I think the province, it was good that they did it at the time, but when they did the blanket thing across the province, we know they're going to get pushback, especially for West Vancouver. West Van, and they it's obviously the affluent community in the Lower Mainland. They're not going to, the reason that they're there is they want to stay anonymous and live in their big mansions. They don't want to see multiplex in their area. Definitely not in my, if I was, if I were in their shoes, I'd feel the same thing. So I do get it. But yeah, it just needs to be thought out better, to be honest with you. Now, locally here, I've been talking about, this is in my neck of the woods. It's about 15 minutes away from where I am. The new Patella Bridge is going to be probably completed pretty soon. It's not going to be named Patella Bridge again. They've retired that name. They've been given a First Nations name from the Kwantlen First Nation and the Musqueam Indian Band. I cannot even pronounce it. It's basically called Riverview Bridge. I told my wife this, and she's like, isn't there a Riverview Hospital that's no longer in service in Coquitlam? And Riverview Hospital was a mental institution. And I'm like, oh, great. You're naming it after
is it Riverview or is it Riverside? I think it's Riverside.
No, it's Riverview. Yeah. And
is it Riverview? Okay.
Yeah, it's Riverview Hospital. And it's they filmed Gothica there, some movies. It's no longer they decommissioned that hospital, but the building, the structure still exists. But yeah, I mean, Riverview Bridge. I'm like, well, isn't that what a bridge is crossing a river? So it's not the greatest name, but whatever. It is what it is. We thought we'd just kind of throw it out there. Now here's an interesting thing that I've, saw on social, nothing to do about mortgages and housing, but it affects us. Now there's a proposal here in the States that is requiring tourists visiting the US will have to submit 5 years of their social media history before they enter the country. Now, the good news is, though, Canadians may be exempt because, you know what, it doesn't imagine us crossing the border and having to submit that. It would take we can't cross in 5 minutes. It would take forever. I don't know. And I was talking to my wife about this as well. She's like, well, technically they can still do that when you cross the border. Check your phone and social media history. If you're talking bad about Trump and politically, they don't let you in. Now, I have Nexus and they've never had to check that with me. We'd love to hear from our audience. Have you gotten any trouble when you're crossing the border to the US? If you've traveled to the States with your phones and all that stuff? Yeah, this is for I don't know, this is you're almost wanting to eliminate any tourism to the States at all. I don't know. What do you make of that?
In this case, Alex, this can already AI is already scraping this. For one, as soon as you when you go into the US, you have to give your eyeball, you have to give your hand and everything. I mean, AI is already scraping stuff. Like when I got off a cruise, it used a picture of my face and already pulled up all my data, like instantly for the US. Like I didn't even have to give my ID. My son, it didn't connect his. I had to give my ID. Mine, that instantly had all my stuff. So like this is already happening. Like if you put anything on social media, people, it is out there for everyone. Like don't think like, oh, I posted on my Instagram, it's a closed account. This data is out there. And so like if you are posting stuff, like you do have to be prepared for the consequences that way.
Yeah, that's why I'm sure a lot of people have these troll accounts that are anonymous, that's not linked to them and all that stuff. So,
Yes. And so, I mean, I think it's a propaganda thing by Trump again, trying to promote them, but it's again, I don't really know what they mean. So like, okay, if I want to go to visit, I have to like actually send my social media accounts to you again. You already have access to them. Like FBI, they already could get access to all of it. So it's kind of like, what is this even for?
yeah, to be honest, like, are you trying to kill your tourism? Like, no one's going to want to go into the States, like, at all. So we'll see how that plays out. Before we wrap up, we have a couple of kind of business stuff to do in our industry that we just want to talk about, share with our audience. Alex, do you want to take the first one here?
Yeah, I want to go over one, especially one that I'm dealing with a couple clients here right now. As a business owner, like you get a lot of really good benefits. For one, you get to pay yourself less and not pay as so much in personal taxes. There's pros and cons to that, especially if you're sole proprietor or incorporated. If you're a sole proprietor and you write off too much stuff, well, what you actually report on your taxes may not be enough to qualify for a mortgage. And so that's where you want to make sure you have someone, your accountant's there to save you money on taxes. That is their job. But if they don't know that, hey, maybe you want to buy a house next year, they might be trying to write too much stuff off and it really could affect you. Recently had someone that been dealing with another broker. They told them that they were good to go with a lender. Everything was set up. And then on the day of financing, they're like, no, actually, it doesn't work. I got in touch with them from the realtor, helped go over everything. Their reportable income was $10,000. And I'm like, this would have never worked. And they don't have a company. They're sole proprietors. I honestly, I don't know what the other person was trying to do. Right away, I showed them this is what we do need to do, which we have alternative lenders that let us use the stated income, the deposits that actually go into the bank account. And that's where we're able to then get them to qualify. But the problem is he obviously is frustrated by that. Well, this person told me I was approved. It's like, no, they lied to you. They actually didn't show you all the information. If you would have been set up as a company incorporated, his options would have been even bigger. That's the really cool thing. When you are incorporated, we actually can look at your personal income and then we get to look at the company's income. Now, the issue is not every lender. We have certain lenders that if we want to use your company's income, every single person needs to be on title. And so if you own with other business owners, it doesn't work with certain lenders, but there's other lenders that will let us use that share percentage. And so that's why, to me, if you walked into one bank, they might say it doesn't work. Well, another bank, it actually may have worked, but you don't even know about it. And that's, again, the benefit as us as brokers is we do get to help with all these different options. One thing I'm also seeing right now is helping people if they have their down payment coming from their company. It's actually financially starting to make sense of buying it in a holding company, buying their new principal residence in a holding company and not buying personally. Now, very big caveat here, people, is you need to speak with your accountant. What is that going to do? When you buy inside of a company, you're not going to get the principal residence exemption. So if you buy this home for $1 million and it sells 10 years later for $2 million, you're paying taxes on that $1 million. So that's where the pros and cons need to outweigh themselves. If you're trying to take out $1 million from your business, well, you'd have to pay yourself like 1.8 to actually get that out. And so this is where the math can make sense in some cases, but has to be looked at properly. I love, especially at tax time, helping people there out, say, hey, you know what? I need your income to show me 150. Talked with a guy today. He's like, Alex, I really didn't need much income here today, this year. Can you tell me what my income needs to be for me to get a $1.1 million mortgage? Able to look at everything and say, hey, as long as your income shows $150,000 total between your employment and dividends, we're good to go. You qualify for everything that you want that way, because we also have your business income. And that's where he had been told by his bank, hey, you need to pay yourself $250,000. That's what his bank told him. And it's like, holy crap, the amount of taxes he would have had to pay on that would have cost him an extra $50,000 every single year. And I mean, in less than a 5-minute call, saving him $50,000.
Yeah, 100%. Now, here's one thing that business owners can use. I think this is more for incorporated. The use of HSA.
Yeah, so this is I've actually personally set this up just recently myself here, Alex. And again, as business owners, the negative of us, we don't really have pensions. I mean, you could say we have CPP, but we have to pay for dental unless you have a bigger company. Myself and Alex, like I have myself and my wife, she does some work for me in my company. That's it. There is no other employee, so we can't get like a defined pension agreement and everything. But you can set up, which is called a HSA, a house savings account, where you can actually set up, instead of having to pay taxes on that, let's say $20,000 you need it for some dental, you're not pulling it out personally. You're actually going to pull it out through the business, and you only have to pay 11%. It has to be structured in the right way. You do have to be reporting like actual T4 income, not only dividends. Again, you have to review it with your accountant. But again, if you have a lot of kids or health stuff, this is something that could save, for my wife and I, it's going to save us like $15,000 in taxes. And the cost for it, when they told me how much it was going to cost, I'm like, are you serious? There's no setup fee. There's no monthly cost for this. It's only if I actually use the money. I'm like, this is a no-brainer for myself and hopefully for other business owners.
I have an HSA as well. And so I've been told that in HSA, a health spending account is essentially converting your claims for, like, let's say massage, dental, whatever, converting that into a business expense. And because if you were to do it personally and then just claim the medical stuff, there's a really high number that you need to a threshold that you need to reach before it actually benefits you. And oftentimes we never reach that threshold, so it doesn't really benefit us personally. But if you to do that through a HSA, converting it into a business expense, and I believe the business has to pay a 10% premium in it through an HSA in order to claim that as a business expense. All the stuff that we're talking about, we, again, caveat, consult an accountant to make sure that this is a viable strategy. Alex and I were just talking about what we do for our businesses, and it may be a different situation for you.
It does not work. It will not work for everyone. And again, like if you're pulling all the money outside of your company, well, this is another one. I've sat with business owners that they incorporate because they believe that they were going to save more money. They make $200,000. They're pulling out $200,000. That company has no benefit to them whatsoever. They're paying higher accounting fees and everything. They should have just been a sole proprietor. A point of a business is actually leaving profits inside of it, so you're not paying as much taxes on it. If you're just doing it thinking you get more write-offs, as a business owner, sole proprietor, incorporated, the write-offs are the same.
Yeah, 100%. Okay, so the next thing I want to talk about is we don't hear this term a lot, but it may be, we might see more and more of it, especially with pre-sale condos coming to completion, and most of them are underwater based on the value, and people are looking for solutions. So this term is called an inter alia, or a blanket mortgage. What is inter alia, you ask? Inter alia, essentially using another property, bringing another property in as collateral, not just the property you're looking to buy. So let's say, for instance, you bought a pre-sale condo, GTA, Lower Mainland. It was, $600,000. But when it came time to completion, the value has gone down to $500,000. Well, you don't have the money to make up the difference, and you can't sell it. You can't assign it. No one's buying nothing. You don't want to give up your deposit, or else you get sued, and it'll be worse off for you. But you have your existing home. Let's say you live in a $1.5 million home in the GTA Lower Mainland. You have maybe, mortgage amounts down to like $700,000 or something like that. So you have some equity there. And for some reason, you can't qualify income-wise through the banks to be able to pull money out to make up the difference for your condo completion. So inter alia blanket mortgages are more so I believe in the private space. I don't believe there's any like institutional lenders that do inter alia. Private lenders will bring in,
it's more on the commercial side.
Commercial side and private, right? So they'll bring in a your principal residence into the equation. So they look at total net, like total value of the two properties. So your $1.5 million property, your house, 600,000 condo. So now it's a 2.1 total value. So whatever you owe, it essentially allows you to borrow more to cover your underwater presale condo by tagging your principal residence as well. So this is kind of a short-term solution. I mean, private lender fees, depending on the situation, I mean, you're looking at 8 to 10%, could be higher if it's a higher loan to value.
Yep.
The fees are, at least 2% of the mortgage amount, and legal fees. You gotta not only pay for your legal fees, but you have to pay for legal fees for the lender. So it oftentimes is about $3,000. Is it a long-term solution? No. It's essentially just to bide you time, to bridge the gap, to get you to the other side. And oftentimes, ultimately, it'll lead you to have to sell the property because you may rent out this condo. You're going to be underwater right from the beginning. You're going to be negative, and oftentimes maybe the solution is just to sell. Take the loss, take the hit, fight. Increase your mortgage on your principal residence, and live to fight another day.
We do them more on development side, someone that we need to go to like an equity-based lender for doing a development. We'll pull in other mortgages that way, or in really bad, messy of closing on condos. That's it. This is not something that people should be like, oh, I'm just going to do this so I can go qualify for a much higher mortgage with a private lender. Like you need to have an exit plan. And that's where I won't even, if someone comes to me asking for a private mortgage outs, if I can't help them come up with an exit plan, I won't do it for them. They'll be like, oh, well, it's fine. Like, we'll figure it out. I'm like, no, you have no way to show me that you're going to get out of this other debt. You're not going to get a higher paying job. I'm not placing you in that. Of course, I don't get paid. Maybe they go find someone else, but I'm not going to have that on my conscience unless I can actually help someone make a full plan.
Yeah, I'm dealing one right now where hearing the nuts and bolts of this, they're already in their inter alia, and it's like, yeah, the payments are killing them, and even their financial advisor is telling them, you know what, you should just cut your losses and sell the property. I'm actually leaning towards telling the same thing. Like, if they sell it on current market value, they're going to owe $150,000 more. Fortunately enough, there's equity in her principal residence, so we either can refinance her principal residence into a B lender or take on a private second just to cover the shortfall, just to live to fight another day. So, yeah, that's one of those suggestions there. Inter alia is kind of a short-term solution, it's really a Band-Aid. It's not there for a long-term thing. It's just to get you to the other side.
Yeah, and that's it. I've had to use them where people they have a business sale that's coming, or they have another property and stuff just isn't going to line up in time. Then, hey, awesome. There's ways to do it. But it's not to, sometimes families are like, well, we can just attach my family's property to it. It's like, no. This is not something that we're going to do just to put you into higher debt.
Yeah, exactly. All right, Alex, I think it's about time to wrap up here. What do you have on docket here?
What do we got going on? It's getting ready. Christmas is what we're less than 15 days away now. I think it's just I gotta get some shopping done.
Well, fortunate enough for me, the shopping is all done by my wife. She takes care of everything, and I'm like, thank you, honey. Yeah. And she's like, it's one of those times when the kids or whoever opens the present and they're like, oh, thank you, Alex, and Mrs. Alex. Yeah. And I say, honey, what did we buy them? And I was like, you're welcome.
Yeah, what were you buying?
Yeah, so
my wife buys most of the stuff for the kids. I always get a few things that I want for them, but it's more I got to get stuff for my wife and other families and stuff.
100%.
I'm usually like a 20th. I'm a 20th, 21st.
Yeah, don't go on. I think the busiest day of the year is the 24th, and it's all men. They go in, oh crap.
Yeah, exactly.
Yeah, so let's hopefully you have Amazon Prime. We talked about it. You actually do have Amazon Prime. But like let's not delay for us procrastinators. For folks on this podcast, this is our second last episode of the year. Next week will be our last of the year, and then we're going to take a break for the holidays, and we'll start up again early January. So on behalf of Alex Shanks, I'm Alex Pang. Thanks for tuning in to episode 67 of the Canadian Mortgage Show. We'll see you next week.
Now, if you enjoyed this episode, make sure to like and subscribe. If you're listening on Spotify or Apple, make sure to follow us. Please give us a 5-star rating. You can even send us an email because we want to know what you guys want to hear about. That's what we're here for. Reach out anytime.